The majority of people have financial freedom as a goal. Having enough cash on hand, savings, and investments to maintain the lifestyles we want for our families and ourselves is often referred to as being financially independent. It involves conserving money so that we can retire or pursue our preferred vocations without being driven by the need to earn a specific quantity of money each year. We must make our money work for us rather than against us if we want to be financially independent. To attain financial freedom, you must pay off your consumer debts, build a safety net of savings, and produce enough passive income from investments or business ownership to meet your current and anticipated future living expenses. Here are top 12 steps to financial freedom. But before starting, don't forget to like and subscribe to our channel for future updates. Let's start. Number 12. Independent income. Having sources of regular income that don't require you to work, such as a business, government payments, or other sources, is referred to as having independent income. Exchange your time for money. If you are eligible, Social Security benefits are paid each month. If your business has developed to the point where you can stand back from day-to-day management, you can still be compensated regardless of the amount of time you put in. If you own a rental property, you get a rent payment once a month, even if property management routinely calls for upkeep of the property and faces the risk of renting to a tenant who misses one or more payments. If you make enough money on your own to pay for both your needs and your wants, you are financially free. Number 11. Abundant assets. Financial freedom is typically made possible by assets like cash in bank accounts, stock investments, and valuable real estate. Before you can use such assets in the process of gaining financial freedom, you must first invest in them, often in the form of enormous sums of money over a protracted period of time. For instance, most financial consultants would suggest that you make consistent 401k contributions in order to ensure your long-term security and stability. This may be true for many people if they start investing early in their 20s or 30s. However, people who wait until they are at least 50 years old to start investing won't have enough time to take advantage of compound interest. Usually, their contributions won't even increase if inflation is taken into account. There is a chance of problems when employing assets to achieve financial independence. Think of it as a tricky balancing act. If you utilize this technique to fund your living expenses and wants, you must sell an asset in order to have enough money to pay your payments. Problems may arise if you can't sell an asset like real estate, for example, quick enough to have the money on hand before your bill's due date. These individuals are sometimes referred to as cash-poor millionaires. They are unable to use their assets quickly enough, despite the fact that they are worth more than $1 million. Another, perhaps more significant problem arises when you run out of assets to sell for money before you pass away. Basically, you won't have enough money to cover your expenses if you spend all of your assets too rapidly. Most homes who are financially stable combine the two of these tactics. They presumably also obtain independent income from sources like Social Security, a business, or dividend-paying securities they have invested in addition to having built sufficient assets in the stock market and the property market. They feel more secure financially since they are aware that they have a lot of resources at their disposal in the event of an emergency. Number 10. Life goals. Make a list of all the resources including income and assets needed to maintain the way of life you choose. Include your goal's year of completion as well as whether or not you'll need to make payments toward them over time. The more explicit your goals are, the more likely you are to achieve them. Set frequent financial checkpoints at your current age and go backward from there. These might include specific financial goals or accumulated assets. Number 9. Budget. A monthly household spending plan must be created and followed in order to guarantee that all bills are paid, investments are made as intended, and the growth of independent income is proceeding as anticipated. Making a budget on a regular basis will help you keep on track with your objectives, and will give you more resolve than caving into the need to splurge. Credit cards and high-interest consumer loans impair your efforts to amass wealth. Review the 5 essential budgeting rules of thumb for additional guidance. Number 8. Pay your dues and debts. With interest rates that are often far lower than those of credit cards and store cards, student loans, mortgages, and comparable loans are less risky for your financial circumstances. Using credit cards can lead to the accumulation of hundreds of dollars worth of high-interest debt. Being strangled by debt for years is the exact reverse of being independent. Debt implies obligation and even servitude, which are obviously at odds with the idea of financial freedom. Number 7. Save. Pay yourself first. That is a regular recommendation from financial experts. Enroll in the retirement program provided by your employer, and utilize any opportunities for matching contributions. Setting up an automatic payment from your employer into an emergency fund that may be utilized for unforeseen needs is also a fantastic idea. Or an automated transfer from your bank account. Consider setting up an individual retirement account with a brokerage contribution that is automated as well. However, keep in mind that the ideal amount to save is debatable and that a fund of this kind could not even be necessary depending on the circumstance. Number 6. Invest in your future. The final advice for achieving financial freedom is crucial. Say you follow the suggestions and guidance in this video. Pay off your debt and increase your savings. That might be sufficient to assist you at this time, but what if something unexpected occurs? Are you going to be ready for it? It's crucial to save money for retirement, unforeseen bills, and other contingencies. Whether you work a 9-to-5 job, ask your employer if they can add a retirement plan, or see if they already deduct money from your pay for one. Since the deduction is made before the money actually leaves your account, you never feel as though you are losing money. It's also very fun to check on it occasionally and see how your savings are doing. Next, you should set aside funds for an emergency fund. Depending on the expert, $10,000 is acceptable or 6 months of your earnings. And to be honest, if you don't make a lot of money, such amounts could seem excessive. Start with a target you can afford instead. Like $100 for the first month. Additionally, if your income grows, start raising your objective to $500 per week, $500 per month, and so on. Don't use your emergency fund to pay down a large credit card bill if you've overspent. Instead, focus on finding other ways to earn active income so you can pay it off more quickly. Only unanticipated catastrophes, such as a tree falling on your house, a car accident that requires out-of-pocket expenses, or a trip to the hospital, should be covered by the emergency fund. By saving money for retirement and rainy days, you'll be less likely to find yourself in the same situation as now. Number 5. Invest. The only method for growing your money that has been scientifically demonstrated to work is investing. Now is the time to do your research and choose whether you want to start with an IRA or a 401k. That is the step that is most important. Number 4. Monitor your credit. The credit history of a person has an impact on any interest rates for credit cards, store cards, vehicle, truck, or house loans or refinances. Other prices, including those for life insurance and auto insurance, are also impacted. The claim is that someone who engages in financial irresponsibility may also engage in other risky behaviors, such drinking and operating a motor vehicle. As a whole, people with lower credit ratings actually have more accidents and submit bigger insurance claims than do people with higher credit scores. This is not to imply that having bad credit makes a person a bad driver. Just as a man who is 23 years old and single does not make a person a bad driver. He will have to pay greater premiums each month because, to his youth, being single, and being a man, poor credit is one of the several risk pools that insurance companies consider to determine your monthly premium. Number 3. Bargain. Many Americans are reluctant to bargain for products and services because they believe it makes them seem cheap. Many foreigners provide advice to Americans on how to get past this cultural barrier. Every year, you may save thousands of dollars. Smaller merchants in particular are typically open to dialogue when making frequent or substantial purchases. Significant discounts can be possible. Number 2. Track your spending. Monitoring your spending is a crucial step on the path to financial freedom. You can use a variety of apps that are available online. These apps will provide you with information on your spending habits, overspending categories, total funds in all of your accounts, and debt load. Many of them offer goal-keeping sections in the user interface that will help you keep your attention on your objectives. Number 1. Learn what must be learned. Keep up with news and happenings in the financial world. And don't be hesitant to adjust your investing portfolio as needed. Knowledge is the best defense against those that prey on unsuspecting consumers to make quick cash. When using your credit card, be mindful of your credit limit to avoid going beyond. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel for future updates. Thanks for watching.